So record highs in gold, that is a bull market, right? Bull markets keep making record highs. The gold stocks are all in bear markets, right? They all dropped more than 20% from their highs, and they haven't recovered. So they're still in bear markets. So you have gold at all-time highs in a huge bull market, yet you have the gold mining stocks that should be the primary beneficiaries of the gold bull market, and they're all in bear markets. What does that tell you, right? Investors have got everything wrong, right? They're buying what they should be selling, and they're selling what they should be buying. The market's going to explode, I think. I think we're getting ready for it. Nobody's talking about it. Nobody's paying attention to it. But the fundamentals are great. Certainly, the gold stock investors are not paying attention to it, even though the gold stocks had a good week.
How are you going to kick the can down the road from this one? This is too big. It's a tsunami, which is going to completely wipe out markets, in my view. Normally, I would expect silver to rise at about twice the rate, maybe slightly less than twice the rate that the gold price does. And it hasn't.
That's because they're the ones accumulating it. And at some point, we see the price setting move from the COMEX, move from the LBMA to places like Shanghai.
In today's episode, we feature insights from 3 leading experts on precious metals: Andy Schectman, Alasdair Macleod, and Peter Schiff. They discuss the key factors driving gold and silver markets this week, including central bank moves, inflation concerns, and global market trends. We've watched hours of footage to bring you the most important highlights so you can stay up to date on what's shaping the market right now. Hit the like button, smash the subscribe button, and turn on notifications so you do not miss out our recaps. Now, check our NordVPN deal, the fastest and most reliable VPN on the market. Make sure your data is secure and protected from prying eyes and the government, which is crucial if you are a gold and silver stacker. They can't take what they don't know you have. Get 3 free months today with the link in the pinned comment. Enjoy the episode.
I think the big story on the week was the U.S. dollar, gold. Nobody's really talking about that. The dollar index was down for the second week in a row. And this week was a big drop, about 2% drop in the dollar index. Now, it's still pretty high in the scheme of where it was before Trump was elected. We're about 107.5, but we got above 110 last week. So we're about 2.5% below the high. The euro is back at like 105 after being, I think, slightly below 102 when it hit the low. But we'll see what happens next week. I think if we get another drop next week in the dollar, I'll be pretty confident that we've seen the highs. And this whole move up in the dollar was a gigantic head fake just to get all the traders positioned the other way before they get the rug pulled out from under them. And that's what I've been expecting. Also, gold. Gold today, after hitting record highs just about every day this week in terms of the euro or the pound or the Canadian or Aussie dollars and a lot of other currencies, gold was going up. And it came to within $10 today, maybe even $7 or $8 of an all-time record high. We got up to just about 2,790-ish. And that's about the record high, maybe 27.91, 27.92. So we almost got there. And in fact, gold closed today at 27.71, or for the week. That's about $20, less than 1% below its all-time record high. Up 2.3% on the week. So about the same percentage as the Dow. But again, record highs in other currencies. Silver was up 1.4% on the week, not as much as gold. And it's still below $31. I think it closed around $30.60. That's the buy. I mean, you can certainly keep buying gold. It's going to go higher, I think. But if you don't want to buy at the all-time highs, which is basically where we are in gold, now the chances are these aren't going to be the all-time highs for long. And so most people who buy gold are going to be buying near the record highs because gold's going to keep rising. But again, it's not gold that's rising, it's fiat currencies that are falling, and they've got a long way to fall. So therefore, the price of gold in terms of those currencies has a long way to rise. But silver is what everybody should be buying right now, I think. I mean, it's a steal below $31. I mean, I think 30 is a support. I mean, it can get a little bit below that, and we've done that, 29 and change. But I mean, this is, I think, about as good as it's going to get in the silver market. People should be buying it.
In today's news recap, Trump tariffs could have a massive impact on precious metals prices, but not the way many think. TD Securities' Melik. The newly installed U.S. administration's threats of import tariffs as high as 25% continues to roil commodities markets. And while many market participants are focused on potential shortages of physical gold and silver, that's not where the real impact is likely to be felt, according to Bart Melek, global head of commodity strategy at TD Securities. It looks uncertain. I think that's probably the kindest and mildest thing I can say, Melek said. Recently, we had a so-called blowout in the EFP exchange for physical silver and gold markets, and that was all because markets were concerned about what the tariffs might be. At this point, we are not looking at global universal tariffs, though they may also be coming, as was said in the Oval Office the other day. Right now, the focus seems to be Canada and Mexico. But it's not only the metals market, he added, it's also the energy market, which would be much more important to the broad economy than just the metals market itself. Asked about the impact on the U.S. supply chains from the tariffing of Canadian metals producers like Teck Resources, which sends significant amounts of copper and zinc south of the border, Melek said the U.S. administration could be creating an intractable problem for their own industry. We are a big exporter of zinc. That may very well be one of our largest sources of metal exports directly, and the U.S. certainly is a big customer of it, he said. What would it mean? Ultimately, there aren't that many substitutes. You could maybe get it from Chinese smelters instead. Ultimately, it means broadly higher prices domestically in the U.S. and some sort of market segmentation, a global price and a U.S. price. Before we show you more clips, smash the subscribe button and check out our huge discount on NordVPN, the fastest and most reliable VPN on the market. This VPN service is a perfect fit for smart stackers who want their privacy protected and don't want their data compromised by prying eyes. For less than the price of a cup of coffee, secure your internet access and get 3 free months with our promo. Believe me, the only problem you'll ever have is that you didn't get it 6 months ago. Let's get back into the episode.
Answer, but this is fundamentally a dollar-based bubble. Mm-hmm. The reason it's a dollar-based bubble is that the dollar is the reserve currency of everybody. It is the international trade currency. It is the international commodity settlement currency. It is the international currency, full stop. So we see the dollar going higher and higher, higher, because people are now waking up to this interest rate problem. Gradually, I mean, there's still a lot of waking up to do. It's undermining the other currencies. Mm-hmm. We now get to a situation where, as I suggested, if we see the 10-year maybe go over 5% yield, which I think it will do in the not too distant future, then I think that will take the equity market out. Then, of course, all the debt problems in other places will start being triggered as well. Bear in mind that the G-SIBs in both Japan and the Eurozone have debt to equity ratios in some cases of over 20 times. Now, that is exceptionally high, and that's come about principally because of negative interest rates. I mean, the only way in which a bank could protect the bottom line was increase its gearing, because the lending margins were just getting compressed and compressed and compressed. So that's what they did. And they're now left with the sort of enormous debt to equity levels. In America, I guess it's around about 13.5, 14 times. Amongst the big GSIBs, this is. Regional banks are a different story. Now, the normal level at the bottom of a cycle, in other words, once all this is sort of washed out and all the rest of it, is for these banks to have debt to equities of around about 7, 8 times, maybe slightly less even. So there's quite a long way to go, as it were, in terms of bank balance sheets adjusting. Mm-hmm. The problem they have is the only way in which the complete banking system can adjust its total outstanding credit is through their customers going bankrupt, because that's the only way it gets wiped out. Some of it, I mean, the difference you've got to sort of understand that money supply is actually sort of a secondary consideration in this, because money supply is distorted by flows between the commercial banks and the central bank, because central bank, the deposits, if you like, the reserves, as they call it, which are really commercial bank deposits at the central bank, are not included in the money supply calculation. So, banks can increase their reserves, and that undoubtedly is going to happen because the Fed will go in there. It'll have to buy bonds because the foreigners and everybody else on the margin isn't going to want to buy anything other than very, very short-term debt. So at some stage, we're likely to see QE come back. Now that will contract money supply, because what happens is it doesn't destroy the credit. It just migrates from commercial banks into the Fed. Other than that, the only way in which this credit gets destroyed is basically when through defaults. So that's going to happen big time. Now, the value of credit, the total value of credit, will diminish because you will have losses booked to, sort of market losses on the value of credit. And that is really the way the adjustment is going to happen. It's going to be mark to market, if you like, in terms of looking at equities, in terms of looking at other financial investments, if you like. And as far as gold is concerned, of course, it will lose mark to market value. I'm talking about the currency losing mark to market value against gold. So this is why gold appears to be going up. It's not. Gold over long periods of time, going back even to Roman times, the prices in many things were really quite similar. There is some fluctuation, yes, but it's pretty minimal. Like it might double or it might halve, sort of thing. This is individual things, but basically, if you have a sort of a broad-based index of everything, measure it in gold, it'd be, it doesn't change. Mm-hmm. What does change, and this is where everybody gets it wrong because they account in these paper currencies, what changes is actually the value of the paper currency. And this is why when we see gold going up, it's really reflecting the fall in the paper currency. But because so few people realize this, they will begin to realize it at a later stage. The thing that's fascinating is if you look at ETF demand, if you like, as a measure of sentiment in Europe, ETF demand for gold ETFs, physical gold ETFs, is pretty much negative in Germany. It's just not increasing. Also around Europe. And if you talk to the retail markets, and I think this is also true in America, you find that people who are hard pressed are selling gold and silver coins because they got to put bread on the table. There's a lot of that going on.
In today's news recap, gold poised to overtake record peak as dollar drops on Trump remarks. Gold prices climbed over 1% on Friday, closing in on its all-time high hit in October as a weakening dollar on U.S. President Donald Trump's push for lower rates and tariff uncertainty drove the metal towards its fourth straight weekly rise. Spot gold prices, which have added 2.7% so far this week, are a mere $17.3 away from the record high of $2,790.15 hit on October 31. One factor certainly seems to be the drop in the US dollar. Some of the biggest factors that are driving it are associated with President Trump talking tariffs, said Bart Mellick, head of commodity strategies at TD Securities. Trump is at risk of elevating prices, and I think the gold market perceives perhaps a higher inflation and possibly a central bank that's more accommodative. In this climate of uncertainty, zero-yield gold continued to shine as a reliable hedge against inflation and instability, while it remains particularly appealing in a low-interest rate environment. At the World Economic Forum on Thursday, Trump called for an immediate reduction in interest rates. The dollar hit an over one-month low, making bullion less expensive for foreign buyers. Trump has said tariffs on Mexico, Canada, China, and the European Union could be announced on February. 1. A short covering rally has boosted spot prices, but ETF flows remain choppy ahead of the Fed meeting, the bank noted. Traders expect the Fed to leave rates unchanged at next week's meeting. Spot silver was up 0.8% at $30.67 per ounce, and platinum rose 0.6% to $948. Palladium gained 0.1% to $190, $992.75, hitting its highest since November 25th. All were poised for weekly gains. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
You look at the amount of silver that India's imported, almost 900 million ounces in the last 4 years, as you mentioned. Russia making a part of their strategic stockpile. China is gone from a net exporter to a net importer. They're flying all around the world to Peru and to South America in particular, disintermediating the market and buying directly from the miners. They're buying doré bars, which are a crudely refined bar, maybe 40-50%, before it gets sent in for further refinement. And they're buying concentrate, which is like a sludge byproduct of the mining and the refining process, and sending it all home, paying double what the West will, and having it refined further in China. 77% of all of China's industrial uses of silver is coming from concentrate that they buy directly from the miners, which disintermediates the marketplace. No one knows how much they're getting. It doesn't affect the price. They're the second largest producer of it in the world as well. And here we are again. We'll have a 280 million ounce shortfall this year again, which is the fourth year in a row over 1 billion ounces short. It's a structural deficit that's not going away. You had 47 million ounces delivered off of COMEX in December. Who's taking that? Where's it all going? On the LBMA right now, you have 800 million ounces. It's the lowest position they've ever had because of that 800 million, 500 million belong to the ETFs. That leaves a float of 300 million ounces. They trade 290 million ounces per day on the LBMA. They trade the entire float. However, they admit to the fact that that trading is 10 times understated because they only post the final settlement numbers, which would mean they're trading as much as 3 billion ounces of silver per day, which is 3.5 times annual global mine supply. They have a 300 million ounce float against between 4 and 6 billion ounces short naked. 90+% of all of those short trades are naked, meaning there's nothing behind it but stupid commercial banks' ability to continue to suppress the price. And that's something that I think needs to be understood because what it is a powder keg waiting to happen. And whether it be a delivery failure or a force majeure, on COMEX, silver is rehypothecated close to 2,000%, meaning 20 people hold a 5,000 ounce contract. if every one of them stand for delivery, one will be lucky to get the metal, the rest would be cash settled or force majeure. You have military industrial complex that needs silver. It is omitted in the supply demand numbers. If you Google H.2768, I believe is the number, that was a congressional hearing in 1942 where they basically they're talking about using silver for war purposes, and they said at the present rate we're using 200 million ounces of silver per year for military. That doesn't take into account the aerospace and the ICBMs. All of these super high-tech military applications need copious amounts of silver. So take a step back and ask yourself, why would 8 commercial banks be stupid enough to have the largest concentrated short position in any commodity ever traded in the history of COMEX on silver? Why would those same banks be short between 4 and 6 billion ounces of silver in London off of a 300 million ounce float? Because they're stupid, number one, as stupid as a mud wall, and number two, they're being told by very powerful people, in particular the military industrial complex, to keep the price low because they need it to make high-tech weaponry to sell all around the world. That's why it's happening. And the difference now is that the countries like China and India and Russia are not only coordinated and sophisticated and motivated, but they're wealthy enough to exploit the delivery mechanism. That is what is different. No one ever stood for delivery. These countries were not motivated nor coordinated to stand for delivery, and they are now. And that's where this ultimately ends. I look at silver as the most asymmetrical risk-reward trade I've ever seen. Lowest downside, best upside. And one of these days, look, the only way that you can successfully manipulate a market over time is to push it in the direction it's going. For a very long time, silver was very easy for these banks to manipulate. But being on the wrong side of a naked short right now in this market, where countries are actually including them into their strategic stockpile, where China is flying around the world buying concentrate and doré, tells me that this game has never been closer to ending. And really, they understand what we're doing, and they're using our suppression against us. It's jiu-jitsu. Use your opponent's leverage against you, and they are. The reason they're not bitching about our suppression is because they're the ones accumulating it. And at some point, we see the price setting move from the COMEX, move from the LBMA to places like Shanghai, where, by the way, Pierre Lassonde said the price ultimately will be priced in the East, not in the West, when the volume on Shanghai surpasses COMEX. Well, just recently, the Shanghai Metals Exchange and the Shanghai Futures Exchange combined volume is greater than that of the COMEX, making it number 2 most heavily traded platform for gold in the world. So how close are we? A lot closer than we've ever been, in my opinion.
Do you agree with the insights from Andy Schectman, Alasdair Macleod, and Peter Schiff? Are they spot on? They've broken down the key drivers of the gold and silver markets this week. Do you align with their analysis, or do you have a different perspective? Let us know your thoughts and predictions for gold and silver in the comments below. And don't stop here. Watch this next episode right here because it's a perfect fit for you. I'll see you on the other side.